Would you bet on a heavyweight or a high flyer? If you had to pick a fighter, would you go for a rock solid heavyweight who can take a punch and keep going, or a flashy high flyer who can deliver knockout blows but might hit the mat just as fast? In the stock market, you don't have to choose. You can bet on both with a long short strategy. Today on Sensa Edge, we're pairing up Johnson & Johnson J&J, the defensive heavyweight, with the Marriott, the high flying economy sensitive play. The strategy isn't about predicting where the market's going. It's about staying balanced and profiting from relative strength. Stick around, because if you are still making all in bets in this market, you are basically stepping into the ring blindfolded. Let's change that. Good morning, everyone, and welcome back to the Sensa Hedge. This is your host, Zoheb, where we don't just throw darts at the market, we aim with general precision. Today, we are going to talk about strategy that lets you hedge the risk while staying opportunistic. The long short equity trade. Specifically, we're looking at Johnson & Johnson, longing that, and shorting Marriott, MAR. This isn't a more sophisticated strategy overall, and like any unruly set of toenails, which needs a little extra attention to get everything managed. This is hedge funded style strategy. It's what's known as a market neutral because it's neither bullish nor bearish. If you're just blindly going long or short in the market, you might as well be playing musical chairs in a hurricane. Markets are choppy, volatility is unpredictable, and single directional bets carry too much risk. So we are looking at long short approach, pairing a long position with a short one. So we profit from relative performance rather than just guessing the market direction. More important, we are going to tackle the elephant in the room, which is the risk. If ever there were something that carries a lot of risk, it's having an elephant in the room, much less trying to tackle it. We'll also hit on how to position size properly, how to manage the risk so you don't wake up one day wondering why your brokerage account looks like a crime scene, possibly involving that particular elephant over there. The current market, right? A quick background. It's already like a roller coaster with a few missing bulls, inflation still lingering, interest rate uncertain, recession worries always lurking. The problem, picking one particular stock and going all in, is like betting everything on a red on a roulette table. Instead, we are looking at longing the J&J, a defensive, stable stock with a consistent earning and a solid dividend, and going short on the MAR, which is a cyclical hotel chain. Let me bring my screen here as I speak to that. I'm again going into the Sensa market. As I can see in the particular dashboard, if I open the tab here, J&J is already here. Which is a solid defensive market, which is solid dividend yield. We can see that the Marriott, which is a cyclical hotel chain that's more vulnerable to the economic slowdown. This is the long short equity strategy, a way to profit from one stock performing outperforming the other rather than hoping the entire market goes in your favor. So what do we do? If I open this particular option strategy screen on the Sensa market, I've picked already J&J, a long call. Again, quick background, right? J&J is a healthcare juggernaut. It's not exciting, but it's steady, profitable, and people still would need to go for a medical products no matter what the economy does. Once the market smashes a few faces, those band-aids will start selling for themselves. So we are longing the J&J here deep in the money, and we are shorting the Marriott. Marriott depends on the travel and discretionary spending, both of which gets crushed in the slowing economy. If consumer spending weakens, MAR are more likely to struggle. The goal, J&J should outperform MAR. J&J should fall less. If both fall, J&J should fall less. If the both rise, J&J should rise more. The relative strength approach reduces the market exposure and lets us profit off the difference in performance rather than absolute stock moves. Again, managing the position, which is the key. It's position sizing on the long short trade is critical because volatility isn't equal between this particular different stock. As you can see here in this particular screen, J&J in this particular thing, it's the implied volatility right around like somewhere less than 20, 17.89, which is fairly tame. And MAR's volatility in this particular case, I'm like deep in the money. Puts, it's somewhere around 19, which is more aggressive. Again, to balance this particular trade, we size our position based on the volatility. Again, if I go deep in the money in this case, right, you can see the implied volatility change here. Smaller position in MAR, the larger the position in J&J. If we buy like $10,000 of J&J, we short around 6,000, 7,000 of MAR. To normalize the risk exposure. The key, you're not trading equal dollar amount, you're trading equal risk exposure. Again, they don't give out the major league the same bat as the little leaguers, right? Same principle here. Manage this particular unlimited risk. Here in this deep in the money options, again, let's talk about this big scary part, short selling as theoretically as unlimited risk. Yes, in theory, Marriott could be bought by the aliens like $1,000 a share overnight. Again, there's a joke in there, but the illegal aliens in the short-term housing, but again, it's stupid enough to find it much less printed. To avoid this particular disaster, we use deep in the money option instead of outright shorting. Deep in the money put options on the MAR let us mimic a short position with the bargaining requirements and borrowing headaches. Deep in the money call option for J&J, if I go and switch this particular tab here, right? Again, gives us a long exposure with a less capital commitment. So the leg one setup here is the long delta position on the J&J, which is the deep in the money call, and you are shorting one delta position, which is deep in the money puts, which is the long put position. As long as the ratios above are respected, your position should more or less stay neutral with market swings, allowing for relative value position. Again, maximum risk. Technically, we can lose the entire premium on both the option, but that would mean the J&J got wrecked and the MAR mooned. This is why we balance the trade with proper position sizing and don't overweigh one particular leg. Maximum reward is unknown at this point of time, but we do well know if economic headwinds hit, MAR struggles while J&J could hold up. Probability consideration, again, we are not guessing market direction, we are betting on relative strength. If J&J outperforms MAR even by a few percentage points, we win. Long short trades make sense. The market is unpredictable. You don't want full long or a short exposure. You want to see one stock poised to outperform another due to macroeconomic factors. Again, you want to reduce the directional risk while maintaining that particular edge position. And that's it for today's episode. The long short strategy is a hedged approach to equity investing, and this particular market hedging is survival. Keep the risk and position in check. The size matters, and thank you for watching. Happy trading. Thank you all.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.